Welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us for our market insights and observations. Today's Thursday, August 24th of 2023. Let's talk about three topics we're paying attention to. Markets are, so you should be too. Thanks for watching. Our three topics right now, markets have been choppy. Volatility has sort of worked its way into the market. That's not uncommon. We just finished second quarter earnings season. We still have a couple more companies that are actually reporting. Last night after the close, a big tech company, chip maker, blew out earnings. And that was on the AI, artificial intelligence sort of demand, over 400% increase there as a result. So there are companies that are winning and there are companies that are losing, much like the retailers I spoke about on earlier Fox Business earlier this week, where there are some retailers that are really winning, executing in a market, a good market, bad economy, great market, so on and so forth. It doesn't really matter. So that's why you want to sift through. You don't want to set it and forget it. You don't have a sort of an index portfolio. We have a more of a customized approach to each client, each portfolio, as well as each individual equity or even sector. And we'll get into sectors a little bit later for market opportunities. But right now we're reluctant to chase the bounce because of August, September, October, but we're positioned for any market opportunity that comes our way. We're also going to talk about, again, volatility in the market, again, because of Jackson Hole. Basically, it's the two-day symposium kicked off by the Federal Reserve. And basically everyone around the world who is a finance minister or a key muckety-muck in the finance world, from basically private equity, everything else. And so also we'll talk about market opportunities. But why, Rob? Why are we reluctant to chase basically the first bounce attempt? What you're looking at are two different sort of captures of a statistical or of the technical analysis that we look at as well. When we go to reallocate or decide when we're going to re-enter or average in or rebalance into markets, we look at the technical aspect of markets. This is the S&P 500 represented by SPY, as well as QQQ is the NASDAQ. So think large cap tech on the other side here. And the blue line and the red line. So on the charts, what you have are a blue line, which is a 50-day moving average, and then the red line below it are the 200-day moving averages. Why that's relevant, why that matters? Well, markets consistently, they don't consistently go up forever. They take a breather, they take a breath. They sort of, if they're leaders in the market, they come back, or sectors that are leading the market, and especially if it's a new bull market, they'll take a breath, they'll take a time out, if you will. They'll go to the bench, get some water, get some air, and get back in the game. But they also let other players get back in. So what they'll do is they'll come back and we'll test sort of moving averages, and those larger companies will do the same, and other sectors will have the opportunity to sort of catch up and backfill. So markets will go up and stretched by a couple of leading sectors, and they'll take a break, they'll have consolidate, and you'll consolidate, and then you'll test on a 50-day moving average, and then you could bounce. So right now, let's look at the S&P 500, and the moving average right now for, and this consistently changes on a daily basis, but as right now for the S&P 500, the 50-day moving average is 44.56, okay? Right now, we could see that the markets are going to hit it, and then back down a little bit, or they could just break right through it with some consistency and some breadth to the upside. So we're at a critical point where we don't want to just jump right in, because if we hit the 50-day, again, because we saw the bounce from the earlier this year, or earlier even this month, you saw the bounce, and then we set in a sort of a bottom at 43.35, but we definitely want to stay away from the 41.39 spot. So we might have temporary resistance at the 44.56 level on the S&P 500. We're going to watch how we close strong, close sort of, Fridays are always important. Keep in mind later this week, we have the Jackson Hole commentary from the Federal Reserve. He could say something tomorrow. It's a Friday. We could get an afternoon sell-off. We could be right around the 44.56 level in the S&P. And if so, the next leg down would be the 200-day moving average. Those are the two sort of key support levels that we are patient when we allocate capital into the market. Same thing as you see for the QQQ. It's the same pattern. It's just, at different levels. The 371 right now is the 50-day moving average. The NASDAQ is right there right now in the triple Qs. But if something were to sort of, the Federal Reserve says, hey, we need to go higher for longer. Interest rates are good, but they're not quite at where we need them to be. that could be a major problem. We could see some significant, drawdown on all major indices. That's why we're going to be patient. The 50-day is now the resistance for the S&P and the QQQ. So it's sort of a ceiling. So we want to make certain before we sort of allocate more capital at this moment in time, because that would mean higher highs moving forward. We want to be patient. And if it drops below, that's wonderful. We've got dry powder to put to work. We're actually looking forward to that opportunity. It's not a bad thing, if you will, because we have some opportunities here below that we're waiting for, just so you know. What are the 3 keys to Jackson Hole? Well, number one, it's a chance for policymakers to reset expectations for financial markets. I talked about it last week. It's the same slide. It's the same expectations. Set expectations, provide more guidance, if you will, on the outlook. And the question is, are we tilting? What's the Fed going to fight? Are they going to fight the inflation conversation? Are they going to say there's still more inflation to go? Or are they going to sort of now look towards the other side of the equation, which could be recessionary considerations? By that, I mean, pressure's building, and I'll talk about that in just a minute. But where are the opportunities? As I said, I would talk about this is a global sector of fund flows. Obviously, technology is leading year to date, if you will, in terms of where everyone's putting their money, and that's actually been the leader. I'll show you the next slide. Obviously, technology has done quite well year to date, but it doesn't always go up. We want to take opportunities to reallocate. Where do you see something like this where do you see an opportunity on this chart? Down here. It's called energy. Now, I don't know if you've been following, but we're going to go into another sort of European winter, if you're Eurozone winter, where you've got, the whole dynamic of energy and the consumption around the globe has completely changed because of the, Ukraine, Russia conflict that we have. And so all of the Russian oil is going to China. All of that is now being redirected. So you've taken a global supply chain that was working prior to the Russia-Ukraine sort of war and conflict, and now you've sort of shattered that, broke it apart. Well, what does that do? Well, what used to take a month to get oil to everyone's door now takes 2 months, okay? Why that's important is because you've just redistributed and redrew the mapping of the supply chain that now takes twice as long. So let's say we get winter that's harsher, because it was mild last year. Everyone is expecting in Europe a really harsh winter, and it was super mild. So what we know is we can't predict the weather, we can't predict the markets, but listen, it's not, maybe I wouldn't bet on 2 consistent mild winters in Europe back to back. That would be something unique. So let's say, Europe needs a lot more oil, but they can't get it from Russia, right? They won't. That means it's going to put a constraint in addition to the supply chain that takes 2 months, maybe it'll go 3 months. All that means is energy prices could go up. We could see we're at $79 a barrel for WTI. We could see that go up to 90, 95, maybe even 100. Who knows? We don't want that, but we also know we're also educated in the sense that their oil markets are being supported. Right? And so they're supported on the price. It used to be inventory. They've changed it now. Sort of OPEC and sort of the Saudis. They've been very they used to, dance around the issues and say, hey, listen, we're going to work on supply here and there. Now they're flat out saying, we have a price that we have to keep the oil levels at for everyone to be profitable, and we're going to maintain that price. So the whole narrative has switched, and they're being completely transparent about higher energy prices moving forward. So they say that now. Don't be caught off sides or surprised in the winter when we see higher energy prices. So what does that mean, Rob? Why are you telling me this? Simply because we've allocated more money to energy, simply because the flows haven't been there. Flows are, we're just basically being a contrarian play right here and using common sense investing for a sector that's completely undervalued by our estimation. Percentage of stocks that have outperformed the S&P 500, the trailing 12 period in the last 12 months. Here's the story. The bottom line is that there's about 8 stocks that are outperforming and leading the way for all of the 3 indices, super performers, and the rest has to play catch up. And that's where you get this big dichotomy right now. So we believe that we will see sectors like energy, companies that are solid within those spaces, sort of move back up with what I said earlier. As technology takes a breather, energy and some other sectors will pull back up, and then that's how markets can get higher from here. If this persists, and if what I just said doesn't play out, then we're just going to have more extremes. So that's not healthy, and that just sets up sort of asset bubbles moving forward. We don't think that's the case, but we're going to monitor that nevertheless. Now, where's the pressure building? Why could markets sell off tomorrow if Jackson Hole has negative headlines such as we're going to have to go higher for longer because pressure is building in the economy for the consumer. Right now, if you just look at mortgage rates, right, the monthly mortgage payment using existing median home price in the U.S. with a 20% down payment on average 30-year mortgage rate right now, the payment is $23.22. It's just setting an all-time high of recent time. Not an all-time high, inflation adjusted since back to the 70s and early 80s. But even right now, if you take a look at it, for the most recent consumer that's trying to get into the market, it's a stretch. Or if you have to refinance, not too many are out there. That's why housing prices and demand is still out there because supply is so short. People with a 3% mortgage aren't going to move, right? And people who are now trying to get in the market are looking at a huge percentage of their income having to be allocated towards housing. That's taking money out of the economy. That's taking money out of the kitchen table, if you will. And then you also add in all the economic pressures from it, all the other aspects of inflation. We're going to see energy go up. We're going to see food prices are, right there. They're going up. It's really expensive to go to the grocery store these days. So we are all feeling it, obviously, the economic. But the housing is another aspect and the element. And also, don't forget that in October, the student housing or student loans, the repayments have to restart. Why that matters is there's a lot of repayments that are going to go, a redirection of discretionary funds that are going to go from one aspect to the other aspect of debt repayment, and it's going to be sucked out of the U.S. economy. So we have to keep an eye on that. That's our sort of a recap of what we're paying attention to, what markets are paying attention to, concerned on. So watch Friday close, see how markets, if it's a normal day, that's great. If we accelerate into the close with a negative sell-off, we could be looking at the 200-day and the 200-day on the S&P and the QQQs. But that'll provide some opportunities. But then we could see the opposite. We could see some sort of more dovish comments from the Federal Reserve Chairman that could send markets to breaking through the 50-day moving averages. So that's where we're sitting back. We're going to take advantage of what comes our way. And thank you for watching. We'll see you again next time.